On this week's episode of The Capitalist Investor, we have a mailbag episode. And one of the questions is, I have a pension from my company, and they are offering me a lifetime annuity payment or a lump sum. Which one should you take? Well, take a listen to our show today, and you'll get some insight on what the best options are for you.
All right. Hey, Tony, what's going on, man?
Hey, man, I'm here. We are here. We got some mailbag topics.
Yep.
I've been sitting on one for way too long. And then there was a nice fresh one in the mailbag. So we're going to talk about the importance and mechanics of rebalancing your portfolio. That sounds as boring. It's as boring as it sounds, I promise. But I'm going to make it really interesting.
All right,
I'm going to try my best.
It.
But there's another one I've been sitting on a long time, and this is on me. But some people, if they're fortunate enough to have a pension, they typically come to the table with either you can take the pension, it's like AKA annuity for the rest of your life, or you can take a lump sum distribution. Which one's better? So we are going to cover these two topics today, and we're going to start with the mechanics of portfolio rebalancing.
All right. Yeah, we talked a little bit about it last week while you were on assignment, and I think we got a question about it, right?
Yep.
So, if you guys out there have more questions or ideas for shows, even if they don't make it on right away, we do definitely talk about them, kick them around, try to fit them in. So, keep those coming.
Yep. So rebalancing the portfolio, I mean, that's just it should be automatic, right? And the psyche behind rebalancing is probably twofold. If your portfolio is doing really well, why would I want to sell my stocks, right? And then if my portfolio is doing really bad, why would I want to put them towards stocks? Right. So the thing is that there was a study not a study, but like J.P. Morgan put out, every year they put out like this 45-page like statistic notebook of all of these crazy statistics of portfolios, how they've reacted over the last year, 5 years, 10 years, 20 years, things like that. And the one thing that they do add, and they have in the past, is talk about rebalancing. And rebalancing, all it's supposed to do is that if you have a game plan, you stick to it. If your portfolio is a 60 stock, 40 bond portfolio, and these are hypothetical, you could be 80-20, you can be 50-50, whatever. But if the game plan from when your plan starts is 60-40, let's build off of that. So let's go back in time. And again, I'm going to try and verbally talk about what these illustrations are. I'm a big picture guy. I'm a big I love drawing and stuff. So me trying to spit this out audio is going to be might be painful. Who knows? Let's sit tight. But let's go back to the financial housing crisis. October of 2007 was basically the top of the market back then. And if you were rocking a 60-40 portfolio going into October of 2007, you could have been 65-35. Right. You could have been overweight in stocks because they were doing so well up until that very point. 18 months later, that is when the market went down nearly 40%. And your 65% allocation to stocks would have drifted all the way down to about 48%. You would have been if you would have just set the portfolio and not done one thing, your 65% allocation to stocks would have gone all the way down to 48%. Not that you would have lost 18%, but what you would have done is see your stocks just shrink.
Yep.
Okay. And in that moment, if you would have rebalanced in 2007, October of 2007, your 60, if you would have taken that 65 and put it back to 60, you would have lost less money. Then let's fast forward 18 months to March of 2009, because that was the bottom.
Right.
You're down to 48% exposure to stocks, and you're probably looking around like scared. Exactly. Like, don't even want to look at statements, don't even want to go outside. Like, Everyone's terrified. Your 401k turned into a 201k.
People are going to all cash.
That's another. That's a whole other topic. But they didn't want to do anything. Why would I put money in the market? The thing's in a free for all, right? What if you would have rebalanced at the scariest moment in that time frame? You would have had more money, because if you would have just left it alone, I have 52% to stocks and 48 to 52 to bonds and 48 to stocks, and I ain't touching nothing. I'm gonna see how this shakes out. If you would have waited several years later, that 48% would have gone back to 69 without doing anything. What if you would have rebalanced? You would have had more money.
Oh yeah.
So in that time frame, so from this is a kind of a later time frame, but from 1995 to 2015, so a 20-year time span, JP Morgan did a study where they did a rebalance every single year, and then they had a portfolio drift where they just shut their eyes for 20 years and opened up and see what happened.
Yep.
If you would have rebalanced, you would have made 7% versus unrebalancing and leaving it alone 6.6. It's a big deal.
Yep.
That's an annualized rate of return.
Mm-hmm.
That's a big deal. So yes, rebalancing in the best times and in the scariest times, you have to do it. But that's the difference. And also, your standard deviation would have went down. Your risk inside the portfolio would have shrunk in this same scenario. So, sorry, a little winded there, but
no, that was a fantastic explanation with actual numbers throughout time.
Yeah.
But yeah, that's what, when we talk about picking a risk tolerance and sticking with it, this is basically exactly what we're talking about. Because if you just don't make any trades ever, your portfolio is going to drift one way or the other.
Right.
When you rebalance it, you're constantly reducing your risk, and that's really what we as advisors and hopefully other advisors are trying to do. We're obviously picking stocks is important, picking investments are important, but we don't have a mechanism to see into the future. We don't have a time machine, or we're not hopping into our DeLorean. So we're trying to manage risk. That's really the primary focus of what we're doing. We're trying to increase your risk-adjusted return. And just letting your portfolio go on into eternity without rebalancing it is going to increase that risk either way. Like Tony just perfectly illustrated. If your portfolios run up, there could be a correction coming up at some point, and not rebalancing that is going to cost you money. Same deal on the other side. When markets are down, it might not feel good to rebalance into more stocks, but that's typically when the market's going to rebound. So, making sure you stay in your range is a very important thing, not only for your returns, but to manage your risk level.
Yep. And the biggest thing is that for all of our clients, we build them a plan, and we want to stick to the plan.
Right.
And if your plan was built at a hypothetical 60-40 allocation, now it's 70-30.
Right.
We're off. We're off the path.
Yep, for sure.
So that's one big thing, and then also that's why we have the investment team that we have, full of these CFAs, is that they're active managing. Right. When we buy a particular stock or a position, and they're like, hey, if we make 20% over the next 6 to 9 months, and we get there in 6 weeks, guess what? They're probably going to take money off the table. They don't want to get round trip. So end of the year rebalancing. There's other strategies that go along with that, such as like tax loss harvesting for non-qualified accounts. But active management, taking chips off the table. Maybe and reapplying those chips sometimes to areas that are underperforming. These are all big things that need to be accounted for if you're doing this on your own. Fortunate if you're working with us, we're doing this for you. Yeah. So, all right. The other topic that we want. Did you want to add anything to that?
Nope, that's good. Yeah. I think we covered it well.
All right. So the other one was, and this one's been sitting in my desk for a while, and I apologize, but. Hey, what if you have you're again fortunate enough to have a pension from your employer that offers a lifetime annuity payment or a lump sum, and you have to choose one or the other. You can't have both, right? So, and I built a perfect case example because I had a client that did this, and it's a Northeast company up here that's very popular. If I said the name, everyone would know who it is. But they had this from our client, and luckily, he started working with us. He was probably about 3 years away from retirement, but he knew this option was coming up. And his options were to take a $60,000 a year pension from this company, joint income for the rest of his life, or take $1.2 million. Okay, both sound very lucrative. The client loved the idea of guaranteed income, but he also looked at $1.2 million. He's like, that's a nice carrot too.
Yeah, that's a nice check.
That's a nice little chunk in the IRA. So the pros. So his plan, when we built the plan, because I built a what if we took a pension, and plan number 2 was what if we took the lump sum. And what I ended up doing for this plan was the very first step is I knew what $1.2 million was the equivalent of on an annualized basis forever. It was $60,000. So what I did is I took that money and tried to find a vehicle that would give us guaranteed lifetime income. So I found an income annuity. And I put $1.2 million in there, and it kicked off income for $72,000 per year. So I instantaneously knew that using an outside personal pension strategy was a better route for him to go. And because he liked the idea of having the money, but also having the income. So we used the planning software to figure out the right mixture for him based on how much money he spent. I don't think he walked into retirement with any debt, but like what his retirement expenses were and his goals and all that stuff. So both plans were working. And the very first plan, we took the pension, and long story short, the pro was that he got $60,000 guaranteed for the rest of his life. But the con is in the back of my mind and his mind is that company going to be around forever? Right? Because if they go out of business or that pension fund fails, man, might have some sleepless nights until something,
for sure.
And that could be a problem. Not everything is guaranteed. So long story short, the plan still worked. He had nearly a 97% Monte Carlo, 97% success rate. Great plan, right? But his ending estate value, so this is where I started figuring out which option really worked the best. And his ending estate value was roughly $4 million. So the day he dies, he's leaving behind $4 million. Now, that's that's not a inflation. That's what he's going to have. $4 million, 30 years from today is maybe the equivalent of $1 million today, right? 30 years from now. So anyway, but that's how I'm going to gauge this. $4 million the day he dies. In this, taking the pension, not leaving $1.2 million on the table. Option 2 was I immediately knew that an outside personal pension strategy was going to create 20% more income. So I built a plan that we took the $1.2 million and put it in his IRA, and then we started figuring out the ratio of how much do we keep for managed money and keep it liquid in his IRA, and how much do we put into an income annuity. And that ratio ended up being around 900 to managed money and 300 to the annuity. And that still kept him at a 97% Monte Carlo. However, the optionality all changed. So first and foremost, he had $5.3 million at ending estate value versus 4.1. That is 30% more money that is going to be left for his family. That resonated with everybody, right? The other thing is that we knew that the income was higher by nearly 20%. The annuity, the outside personal pension annuity, is liquid. You may pay a penalty, but you can go and get that money if you wanted it. If you pick the pension through that Northeast Ohio company,
it's over.
It's over, man. Like it's a binary event. I'm either going to take it or I'm not. And if I take the income, I'll never see a dime,
right?
Except until until one of me and my wife die, right? The other thing is that there was obviously more money to transfer, and that is in the form of the AUM, the assets under management, whatever's left in the IRA, and if there's any money left in the annuity, that would also go to his children, his beneficiaries. And then obviously there's the higher ending estate value. So with all of these things, there was so much more optionality to do it. Even if it was a break even, 60 grand versus 60 grand a year, the optionality opened up for him to have a bite of both sides of the apple.
Yeah, for sure.
So
yeah, a couple things on top of that. I would say, if you have a pension, a lump sum pension option where you could take a lump sum or the income via annuity payment, you almost have to do a financial plan. Because of this analysis that Tony just talked about. If you don't do an analysis like that, you're essentially just guessing, right, on which one is better. And nowadays, pensions will probably eventually go away. Probably our kids won't even know what a pension is. Quite honestly, they already don't know what like a CD is. And the telephones, it's depressing. But so just having that pension is really an advanced decision to make. So you want to make sure you do an analysis like this through a financial plan. It's one of the most important things that you can do for your retirement. But in addition to that, there's some things you should keep in mind. Number one, if you select that income, most likely the most common and default choice is a single life with 50% survivor. So basically, if it's you and they say the pension's mine and, I'm married. If I pass away, that means my wife will only receive 50% of those benefits going forward. How Tony has this one set up, we're taking ownership of the money, right? We're transferring that over into an investment account where it is accessible to us, and we're transferring another portion over to that annuity, which is going to pay a lifetime income, but is also liquid if we need it, and it also will pass to my spouse. There's another calculation we can figure out if we're going to take that income joint or single life. So, we can get really fine-tuned into the exact best way to go with your pension. And it is an important decision. Those numbers that Tony rattled off there about ending estate value, that is real money. That is a real difference in your estate. There's just going to be more money available to you while you're living, and then more money available for your kids or your heirs.
Yeah, so, I mean, most people aren't going to be comfortable leaving $1.2 million and then bank on the pension fund to have enough money.
Yep.
But if you can take the reins into your own hand and ride that horse on your own, it just makes you feel like a lot more in control. Mm-hmm. And you didn't need to leave $1.2 million. This person didn't leave $1.2 million on the table. He got to realize 75% of it, because it was a comfortability factor. Like we could have built more income. We could have done no income. He still would have had a successful plan. But the idea behind everything that we built, we found the sweet spot.
Yep.
Because I knew that we can instantaneously do better outside of the pension that was being offered.
Yep.
So, and as Derek said, like regardless if you have one or not, and it's very, very rare where it's like, man, the pension is so obvious. I've seen them once or twice, and I'm like, I don't even know how they support that. You should turn that on yesterday. But most of the time, an outside personal pension plan can, and it normally works. But now you can go and get the money if you think you made a bad mistake. You can turn on the income. If you don't use it all, it's going to your family. Like, it doesn't end after the last spouse dies. Like, there's so much stuff going on when you're going to create that personal pension. It's just setting it up correctly.
Yep, for sure. So, and last thing I'll mention, these companies are trying to get these pension payments off their books.
Yeah.
So, it's even a much different conversation than it was 10 years ago. 10 years ago, it was probably, let's call it 70-30, where the lump sum was a better idea, 70% of the time. I'd say now, it's probably 95% a better option to take the lump sum and do something like Tony just outlined there. But you never know. So that's why the analysis is important, and also dialing it into your specific needs is going to affect that ratio, like Tony set to that annuity product for that guaranteed income. So, personalizing before we even talk about investments, right? Just personalizing a plan like this is about as important of something that you can do for your retirement as possible.
Yep. So recap, stick to the plan on rebalancing.
Yep.
Rebalance every year, whether you want to or not. Good markets, bad markets, because it does actually lower your risk over time and your returns. It increases your returns over time. And then if you have the optionality for a pension versus a lump sum, that is a big deal. But you have to run the plan. There has to be an analysis and figuring out if there's ways for you. At the end of the day, most people want control of their money. They want to be able to control the optionality of getting that money later if they want, hoping that the company doesn't go out of business. Those are all big concerns. Mm-hmm. And running a plan to figure out the right ratio of building a personal pension is it's priceless.
Yep, absolutely.
All right, D.
So, hey, thanks for listening this week. If you guys have any questions, ideas for a show, hit us up at info@swpconnect.com. Or if you're looking for that financial plan, hit us up. It's an important thing to do. Thanks as always, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.